Right now, there's something critical happening with federal tax rules that could significantly affect millions of senior homeowners across America, and surprisingly, few people are discussing it. April 15th, 2026 is approaching quickly, and after that date, certain consequences begin that could potentially put your home at risk if specific steps aren't taken. If you're 65 or older and own a home in the United States, you need to understand what's happening, because what I'm about to explain is based on IRS documents, federal law, and actual enforcement data that many people haven't seen. Before we continue, let me clarify something important, because there's considerable misinformation circulating right now suggesting the IRS will immediately take your house the day after the filing deadline. That's not accurate. The IRS doesn't knock on your door on April 16th with an eviction notice. However, what does occur after April 15th is a series of penalties, interest charges, liens, and potential enforcement actions that can eventually lead to serious consequences, including the possibility of losing your home. This chain of events begins the moment filing deadlines are missed, or when certain critical mistakes are made that seniors encounter every year. Let me walk through the actual facts systematically. First, we need to understand what April 15 means for seniors in 2026. April 15, 2026 is the federal income tax filing deadline for tax year 2025. This year is particularly significant because of new legislation signed into law in mid-2025 that introduced substantial changes directly affecting seniors and homeowners. If you're unaware of these changes, you could potentially miss out on thousands of dollars in deductions or inadvertently trigger penalties. Under recent legislation, there's a new provision called the Senior Bonus Deduction that provides every American aged 65 and older an additional $6,000 deduction on federal taxes. If you're married and both spouses are 65 or older, that becomes $12,000. This deduction is available for tax years 2025 through 2028 and comes in addition to the regular standard deduction, which for 2025 is $15,150 for single filers and $31,500 for joint filers. However, this deduction has an income phase-out starting at $75,000 for single filers and $150,000 for married couples. If your modified adjusted gross income exceeds those thresholds, the bonus amount begins reducing and eventually disappears. Why does this matter for homeowners? Because if you sold your home in 2025 or are planning to sell, and you don't properly account for the capital gains from that sale, it could push your income above that phase-out threshold, causing you to lose the deduction entirely. Let me explain the facts about capital gains in home sales because this is where many seniors encounter unexpected problems. Under IRS Section 121, you can exclude up to $250,000 in capital gains from the sale of your primary residence if you're single, and up to $500,000 if you're married filing jointly. However, there's an important requirement most people don't fully understand. You must meet what the IRS calls the ownership and use test, meaning you must have owned and lived in the home as your primary residence for at least 2 out of the last 5 years before the sale. Consider this scenario. According to real estate data, median home prices crossed $420,000 in 2025. A senior who purchased their home in 1990 for $100,000 and sells it in 2025 or 2026 for $450,000 has a $350,000 gain. If you're single, you can only exclude $250,000 of that gain, which means $100,000 is taxable. At the 15% long-term capital gains rate, that represents $15,000 in federal taxes. But the impact extends beyond just income tax, because that taxable gain also counts toward your modified adjusted gross income, which can trigger something called IRMA. IRMA stands for Income-Related Monthly Adjustment Amount, and it's a surcharge that Medicare adds to your Part B and Part D premiums when your income goes above certain thresholds. In 2026, the IRMA threshold is $103,000 for single filers and $206,000 for married couples filing jointly. Financial publications have reported that most retirees who sell their homes are unaware that the profit from the sale can increase their Medicare premiums by significant amounts annually, and they often don't discover this until after the fact. The highest IRMA bracket for Part B in 2026 can add several $100s per month to premiums, and Part D surcharges can reach additional amounts on top of that. So, selling your home without proper planning doesn't just create a tax bill, it can raise your healthcare costs for years. Now, let me explain how IRS tax liens work and how they can potentially lead to losing your home. When you owe the IRS money and don't pay, they follow a specific legal process. First, you receive a notice and demand for payment. If you don't pay within the specified time frame, a statutory lien automatically attaches to everything you own under Internal Revenue Code Section 6321. Your house, your car, your bank accounts, everything. For debts over $10,000, the IRS typically files a public notice of federal tax lien at your local county courthouse. Once that lien is on public record, it appears in title searches, which means you cannot sell your home, cannot refinance, and your credit is significantly affected. If you continue without addressing the debt, the IRS can escalate from a lien to a levy. A lien is a legal claim against your property. A levy is the actual seizure of your property. The IRS has legal authority to seize and sell property to satisfy tax debt. In practice, the IRS rarely seizes homes because there are many steps before that happens, and protections exist. However, what people often miss is that it's not just the IRS that can create problems. According to various data sources, property tax delinquency rates nationally have been climbing, and foreclosure filings have increased significantly. Seniors on fixed incomes are particularly vulnerable because when property taxes rise and income stays flat, financial stress increases. The SALT deduction, which allows you to deduct state and local taxes, was raised from $10,000 to $40,000 under recent legislation for 2025, and it increases to $40,400 for 2026. However, most seniors take the standard deduction. Research indicates that approximately 90% of taxpayers take the standard deduction instead of itemizing. When you factor in the new senior bonus deduction of $6,000 per person, the standard deduction floor for a married couple, both over 65, becomes quite high for 2026. That means your itemized deductions, including property taxes, mortgage interest, and charitable donations, must exceed that amount before itemizing makes financial sense. For most seniors, it doesn't. So even though the SALT cap increased, most seniors won't benefit from it, and meanwhile, their property taxes continue rising. Let me explain how IRS enforcement has changed in 2026. The IRS workforce was reduced by approximately 27% in 2025, going from about 102,000 employees down to about 74,000, according to official reports. You might think fewer IRS employees means less enforcement, but actually the opposite is occurring. The IRS is now relying heavily on automated data matching systems and advanced technology to catch discrepancies. The IRS is using analytics to compare what you report on your tax return against data reported by banks, employers, payment processors, and real estate closing agents. The IRS automatically receives Form 1099-S whenever you sell a property, and they receive Form 1099-R when you take retirement distributions. If the numbers on your return don't match the numbers the IRS already has from third parties, you will get flagged. This is particularly concerning for seniors specifically. Financial publications have identified common audit triggers including unreported capital gains from home sales, missed required minimum distributions, overvalued charitable donations, and incorrect reporting of Social Security income. Recent articles have identified 4 specific tax mistakes seniors commonly make. The first mistake is failing to report all income sources because seniors often have multiple 1099 forms from pensions, Social Security, investments, and part-time work. The second mistake is assuming Social Security isn't taxable when in fact up to 85% of your Social Security benefits can be taxed, depending on your other income. The third mistake is claiming large charitable deductions without proper documentation, especially for donations over $250, where the IRS requires a written acknowledgement from the charity. The fourth mistake is missing required minimum distributions because once you turn 73, you must withdraw a minimum amount from your 401k or IRA every year. And if you don't, you face a penalty of 25% of the amount you should have withdrawn. Any of these mistakes can create an unexpected tax bill, and that unexpected bill can start the lien process described earlier. Now, here's another critical issue, and this one is about scams. While the IRS can create legitimate problems, there's an entire industry of criminals pretending to be the IRS and specifically targeting seniors. The IRS published its list of tax scams for 2026, and phone scams are at the top. The Federal Trade Commission issued warnings in early 2026 about calls from fake agencies. These scammers use spoofed caller ID to make it appear the call is coming from a real government number, and they demand immediate payment by gift card, wire transfer, or cryptocurrency. The IRS has been very clear about this. The IRS will never call you demanding immediate payment. The IRS will never threaten to arrest you over the phone. The IRS will never ask for gift cards or cryptocurrency. If you receive a call like this, hang up immediately. Why this matters for your home? Some of these scam operations have convinced seniors to take out home equity loans or reverse mortgages to pay fake tax bills. Once that money is gone, it's gone, and now you have a real debt against your home that you didn't need. So the threat isn't just from the IRS itself. It's also from criminals exploiting fear of the IRS. Now let me bring this together and tell you exactly what you need to do before April 15th. Number 1. File your tax return even if you cannot pay. The failure to file penalty is 5% of your unpaid taxes per month, up to 25%. The failure to pay penalty is only 0.5% per month. So filing without paying is significantly less costly than not filing at all. Number 2, claim the senior bonus deduction. If you're 65 or older and your modified adjusted gross income is under $75,000 single or $150,000 married, you're eligible for an additional $6,000 deduction per person. This is new and millions of eligible seniors may miss it. Number 3, if you sold your home in 2025, make sure you properly calculate your capital gains exclusion under Section 121. Track every capital improvement you made to the home, because each improvement increases your cost basis and lowers your taxable gain. New roof, new kitchen, added bathroom, replaced HVAC system, all of these count. Number 4, check your Medicare IRMAA exposure. If the profit from your home sale pushed your modified adjusted gross income above the thresholds, you will pay higher Medicare premiums. That surcharge is based on your tax return from 2 years prior. If you had a life-changing event like retirement or the death of a spouse, you can file an appeal using Medicare Form SSA 44. Number 5, don't ignore IRS notices. If you receive a letter from the IRS, open it immediately and respond within the time frame specified. You have the right to request a collection due process hearing within 30 days. You have the right to set up an installment agreement. You have the right to request currently not collectible status if you genuinely cannot pay. And you have the right to submit an offer in compromise to settle for less than you owe. Number 6, protect yourself from scams. The IRS contacts you by mail first, not by phone. Never give personal information or payment to someone who calls claiming to be from the IRS. Number 7, if your situation is complicated, get help. The IRS offers free tax preparation through the VITA and TCE programs for seniors and low-income taxpayers. AARP Tax Aid has thousands of free locations across the country. You can find one near you by calling 1-888-227-7 or visiting aarp.org/tax. If you owe money and cannot pay, a tax professional or enrolled agent can help negotiate with the IRS on your behalf. Let me leave you with the complete picture. The concern that seniors could lose their homes after April 15th is not fiction, but it's not a guaranteed outcome either. What is real is that missing the April 15th deadline starts a clock. Penalties begin accruing immediately. Interest compounds daily. After multiple notices, the IRS can file a lien against your home, and if nothing is done for an extended period, they can escalate to a levy. At the same time, rising property taxes, surprise capital gains from home sales, Medicare surcharges, missed RMD penalties, and scam artists are all working against seniors simultaneously. The system is not designed to be easy to navigate, and the people who face the most difficulty are often those who don't know the rules. Foreclosure filings have increased significantly. The IRS workforce was reduced substantially, but automated enforcement is expanding. Audits are expected to rise, and a brand new $6,000 deduction exists that millions of eligible seniors may never claim simply because they didn't know about it. That's why I made this video, not to create fear, but to ensure you have every piece of information needed to protect your home, protect your money, and protect your family. April 15th is approaching. File your taxes. Claim every deduction you're entitled to. Don't ignore letters from the IRS. Don't fall for scam calls. And if you need help, ask for it because the help is free and available right now. If this video helped you understand something you didn't know before, please subscribe and share it with a senior in your life who needs to hear this, because the information here could genuinely help someone protect their home. This is Timothy from US Updates Hub, and I'll see you in the next update. This video is for educational and informational purposes only. It does not constitute legal, tax, or financial advice. Tax laws are complex and individual situations vary significantly. Always consult with a licensed tax professional, CPA, or enrolled agent before making any decisions regarding your taxes or property.